It is a Tuesday morning, and you are sitting at your kitchen table with a cup of coffee that has gone slightly cold because you forgot about it while you were doing the math. The math started simple. You typed a number into a calculator, a monthly income number, the amount your life actually costs per month. Rent, groceries, car, phone, utilities, the subscriptions you actually use, and the one you keep forgetting to cancel. You added it up honestly for the first time in a long time. The number was $3,400. You stared at it. Then you typed a different question. How much money sitting somewhere, doing something, would produce $3,400 every single month without you doing anything at all? Without an alarm, without a commute, without a manager, without your body needing to be anywhere at any specific time. Just money producing money every month, automatically, while you live your life. That question has an answer, and the answer is more specific than most people expect and more reachable than almost everyone assumes. First, you need to understand what a dividend actually is. When you own shares of a company, you own a small piece of that company's earnings. Many companies take a portion of those earnings and distribute them directly to shareholders on a regular schedule. Quarterly, usually, sometimes monthly. That distribution is the dividend. It arrives in your account the way a paycheck arrives, except the company is not buying your hours. It is paying you for ownership, for simply holding the asset. You did not work that Tuesday. You did not send an email. You were asleep or making coffee or sitting at a kitchen table doing math. The dividend came anyway. The yield is the number that connects your invested capital to your income. If a fund pays a 4% annual dividend yield, that means for every $10,000 you have invested, you receive $400 per year, or roughly $33 per month. The yield is the engine size. Your invested capital is the fuel. The income is what comes out the other end. Now back to your $3,400 a month. That is $40,800 per year. To produce $40,800 per year from dividends, you divide your target income by the yield you are earning. At a 4% yield, the math is $40,800 divided by 0.04. The answer is $1,020,000. At a 4% dividend yield, you need approximately $1 million invested to live off dividends at a $3,400 monthly lifestyle. Sit with that. Not because it is small, it is not small, but because it is a number. A real, specific, calculable number. Not a dream, not a feeling. A division problem with a fixed answer that does not care how you feel about it. But yield is not fixed. It moves. And the yield you chase determines everything about how safe or how dangerous your dividend income actually is. This is the part most people skip, and the part that costs them the most. A stock paying a 12% dividend yield sounds extraordinary. Double digits. The income appears enormous relative to the capital. But a 12% yield on a stock is almost always a warning sign, not an opportunity. It typically means the market has driven the stock price down significantly because investors expect the dividend to be cut. The yield looks high because the price is low, and the price is low because something is wrong. Chasing yield without understanding why the yield is high is one of the most reliable ways to watch your income evaporate and your capital shrink at the same time. You get less income than you expected and less capital than you started with. The double loss nobody talks about when they show you the 12% number. The sustainable range sits between 3% and 6% for most well-constructed dividend portfolios. This is the range where the yield is meaningful enough to produce real income and stable enough that the companies or funds generating it have a genuine history of maintaining and growing that payment over time. Within this range, the math changes significantly depending on where you land. At 3% yield, your $40,800 annual income requirement needs $1,360,000 invested. At 4% yield, it needs $1,020,000. At 5% yield, it needs $816,000. At 6% yield, it needs $680,000. Every full percentage point of yield you can sustainably earn reduces your required capital by hundreds of thousands of dollars. This is why the yield question matters as much as the capital question. The target is not just a number, it is the intersection of two numbers, how much you have and how much that amount earns. Now let us talk about what actually produces these yields in a reliable way, because the vehicle matters as much as the destination. Broad dividend index funds like those tracking dividend aristocrats or dividend growth companies are among the most reliable sources of consistent dividend income. These are companies with decades-long records of paying and increasing their dividends through recessions, market crashes, inflation spikes, and global disruptions. They did not cut in 2008. They did not cut in 2020. They kept paying, and in many cases, they kept growing the payment. The yield on these funds typically sits between 2.5% and 4%, lower than the exciting numbers, but sustainable in a way the exciting numbers are not. Real estate investment trusts, known as REITs, are required by law to distribute at least 90% of their taxable income to shareholders as dividends. This legal requirement produces some of the highest and most consistent dividend yields available in the public markets. Diversified REIT funds often yield between 4% and 6%. The trade-off is that REITs are more sensitive to interest rates, and their prices can be more volatile than the broad market. The income tends to stay consistent even when the price moves. The price volatility is the cost of the higher yield. Covered call ETFs have become increasingly popular as income vehicles because they generate yield by systematically selling options on the stocks they hold. Funds in this category have produced yields between 6% and 12% in recent years. The trade-off is that covered call strategies cap your upside participation in strong bull markets. You receive the income, but give up some of the price appreciation. For someone living off dividends who needs the income more than the growth, this trade-off can make sense. For someone still building toward the number, giving up growth for income too early is a significant cost. Business development companies, known as BDCs, lend money to small and medium-sized businesses and are also required to distribute the majority of their income to shareholders. They often yield between 8% and 12%. The risk is that their loan portfolios can deteriorate in economic downturns, and their dividends can be cut when credit quality falls. They are the highest yielding and the most economically sensitive of the standard dividend vehicles. A well-constructed dividend portfolio for someone intending to live off the income permanently might blend these vehicles deliberately. A core of 50% to 60% in broad dividend growth funds for stability and inflation protection. A meaningful allocation of 20% to 30% in diversified REITs for higher current income. A smaller satellite allocation of 10% to 20% in covered call funds or selective high-yield positions for additional income generation. This kind of construction might produce a blended yield of 4.5% to 5.5%, while maintaining enough stability and growth that the income holds or grows over time rather than eroding. At a blended 5% yield on a $3,400 monthly lifestyle, the number is $816,000. That is your dividend independence number for this life. Not $1 million, not $2 million. $816,000. Intelligently allocated, producing $3,400 every month, paid to you in quarterly or monthly increments, deposited automatically into your account, whether you are awake or asleep, working or not working, present or absent. Now let us do this for different lifestyles, because the math is the same equation, and the only variable that changes is your monthly number. A minimal life. Shared housing, no car payment, cooking at home, no subscriptions beyond the essentials. Total monthly cost, $2,000. Annual income needed, $24,000. At 5% yield, invested capital required is $480,000. Under $500,000 produces a modest but complete financial independence at this lifestyle. It is a real threshold, a reachable one for many people within a decade of disciplined saving. A comfortable middle life, a decent apartment, one reliable car, eating out occasionally, a few subscriptions, some travel once a year, total monthly cost, $4,500. Annual income needed, $54,000. At 5% yield, invested capital required is $1,080,000, the million-dollar threshold. This is the number most people intuitively associate with being set, and they are not wrong. $1 million in a well-yielding portfolio genuinely produces a comfortable American life without working. An abundant life. A nice house, 2 cars, Regular dining out, quality travel twice a year, generous spending on the things you actually value. Total monthly cost, $8,000. Annual income needed, $96,000. At 5% yield, invested capital required is $1,920,000. $2 million, roughly, for a genuinely abundant life entirely funded by dividends. A wealthy life. Everything above, plus a vacation home, significant travel, philanthropy, private school, staff who handle things you do not want to handle. Total monthly cost, $20,000. Annual income needed, $240,000. At 5% yield, invested capital required is $4,800,000. $5 million for a life where money is genuinely never the reason you do or do not do something. The numbers scale predictably because they are math. Every additional $1,000 per month of lifestyle you add costs you $240,000 in required capital at a 5% yield. Not $240, not $2,400, $240,000. This is why lifestyle is the most powerful lever in the entire equation. Not return, not yield. Not which fund you pick. The gap between $2,000 a month and $4,500 a month in lifestyle costs you $600,000 in required capital. You could spend years trying to optimize your portfolio yield by 0.5% and move the number by less than the gap you could close by cutting $500 from your monthly spending. There is one more thing the math requires that the headline numbers never include: taxes. Dividend income is taxable. The specific rate depends on whether the dividends are qualified or ordinary, your total income level, and the account types holding the investments. Qualified dividends from stocks held longer than 60 days are taxed at 0%, 15%, or 20%, depending on your income bracket. REIT dividends and BDC dividends are generally taxed as ordinary income at your marginal rate. Covered call fund distributions often contain a mix of return of capital, ordinary income, and capital gains with tax treatment varying by fund. A thoughtfully constructed dividend portfolio held across a mix of tax-advantaged accounts like Roth IRAs and taxable brokerage accounts can manage this meaningfully. But the gross income number you need before taxes is higher than the net number your life actually costs. If your life costs $3,400 after tax and your effective tax rate on dividends is 15%, you need to generate closer to $4,000 gross. That adjusts your capital requirement upward by roughly 15% to 20% across the board. The last thing nobody says clearly enough: dividend income is not perfectly stable. Companies can cut dividends. Funds can reduce distributions. Interest rate changes affect REIT payouts. Economic contractions affect BDC loan quality. A diversified portfolio across many dividend sources reduces but does not eliminate this risk. The practical approach is to build toward a capital base that produces 10% to 20% more income than your actual monthly need. Not because the extra income is the point, but because the buffer is the cushion that absorbs a dividend reduction without your life breaking. If your life costs $3,400 and your portfolio produces $4,000, a 15% dividend reduction in one holding becomes an inconvenience rather than a crisis. You are back at the kitchen table. The coffee is fully cold now. The number on the calculator is $816,000. That is the number for this life, this lifestyle, this set of choices. It is not the number for a different life with different choices. If you spend the next year cutting the monthly cost from $3,400 to $2,800, the number drops to $672,000. If you earn a higher blended yield by understanding the vehicles rather than chasing whatever pays the most, the number drops further. The target is not fixed. It is the output of decisions you are making right now about how much your life costs and how carefully you construct what your money does while you sleep. The Tuesday morning question was, how much money would need to be sitting somewhere, doing something to produce your life automatically? The answer was never one size. It was always your size, and your size is a calculation, not a wish. not a milestone belonging to someone else. A division problem. Your annual income requirement divided by your sustainable yield. The answer sitting there on the screen waiting for you to decide whether you are going to do anything about it. The coffee is cold. The number is clear. The next move is yours.